All right. Well, I want to go ahead and get started and just let people trickle in, I guess.
Yeah, yeah, let's do it. We are recording, so we can dive in whenever you want. Um, if this is the same spiel that I give every time, so if I sound like a broken record to you, to those of you who have been here before, I apologize. But I just want to emphasize that this this series is all about having more discussions with our community so that we can normalize women talking about money and talking about ways to grow their wealth, talking about questions that they have about anything that's coming up in a timely manner as it relates to our finances. And today, our topic is on inflation. We're really hoping that this is informative. We invite you to ask whatever questions that you have. So, we don't have rules as far as how questions need to be asked. You can ping us directly if you don't feel comfortable sending a chat to the group. If you do, feel free to send a chat to the group. Feel free to just come off of mute if you have a question, especially if it's on the topic of anything that we're bringing up at that moment. So, just I really want to highlight that we love when this is interactive. I feel that everybody gets a lot more out of it when it is. So, please don't hesitate to ask your questions.
Yay.
All right, Susan, you should be all set to share.
All right. Oh, let's see if I can figure out
You
how
got
to
this.
do this
I believe
again.
in
We practiced this the other day.
you.
Okay. I have to share um, from Canva first.
And by the way, while Susan's getting this set up, if you have a burning question, even if it's not on topic, feel free to ask it or put it in the chat.
All right. Can you see that?
I can.
Yes. Yay.
This is a big milestone.
Yeah. Yeah, I am not super tech savvy, so this is a big plus for me, being able to get the presentation started.
You're doing great so far.
All right, so as Caitlin said, today we are going to talk about inflation, and that's very apropos right now. I'm sure we are all seeing the impacts of inflation, especially at the gas pump. So we'll talk a little bit about that and why it's happening and what we can do to protect our cash in our portfolios while inflation is really high. All right. So, just our usual disclaimer, this is not personal financial advice. This is for education only, and you should always do your own due diligence in relation to your own personal financial portfolio. All right. So, what is inflation? So, I'm sure we've all talked to, our grandparents in the past, and they've been like, "Oh, I could buy a cup of coffee for 5 cents," and now it's like $5, right? So that's inflation, right? So it's an erosion of our purchasing power over time, essentially. A dollar 50 years ago doesn't buy as much as you could buy more than you could get today for it. So our purchasing power is becoming eroded over time. So if you just had $100, you put it under your mattress 50 years ago, it's not going to be worth nearly as much today. So that's why we care about inflation. That's why we're going to talk about how you can stop that erosion of your money over time. All right. And so, what actually causes inflation? One of the big aspects is production costs, right? And we're seeing that right now with the price of oil going up. So, not only is it more expensive to fill our cars with gas, we're also seeing things that use petroleum going up in cost too. And I think we're going to see more and more of this, right? As this war drags on, there are also belated effects, right? So we're not even really seeing the full impacts yet of this. I think, fertilizer is getting more expensive. Plastics are going to get more expensive. So that's a big thing, right? Is that it costs more to produce these goods and they get more expensive. The second cause of inflation is higher demand of goods. And if you've been to one of my tax presentations before, I sometimes have a slide in there that says, the biggest wealth killers are inflation and taxes. I'm like, well, I can't do much about inflation except to stop buying as much stuff. And that's because high demand causes inflation. And we saw this back after the pandemic, right? When the prices of real estate really took off. People were able to get cheap money because interest rates were low at the time. And so there was this huge demand for buying real estate because you could get these cheap mortgages. And we saw prices just skyrocket, right? So that's another cause of inflation. And then the third big cause is fiscal policy. So I just mentioned interest rates, right? So that's one way that fiscal policy can influence inflation. So when interest rates are really low, it's easier to borrow more money and then people can buy more things, right? And that drives the prices up. Another way that fiscal policy influences inflation is by printing more money, right? And we saw this with the COVID stimulus checks. That was another big driver of inflation at the time, right? So people were getting these checks in the mail. They're like, oh, I have this money to spend, right? And they were going on buying more things, right? And so in that way, it caused the prices of everything to go up because there was more demand. They could charge more for these goods because people had the money to spend, right? We also see this like with college costs, right? That's another big thing. People have the money to spend because they've been able to get these loans, these massive loans. And because of that, the colleges can charge these massive prices, right? So that's another area where we see this. And we talked about this a little bit before when we were talking about the Fed setting interest rates a couple months ago. We did a presentation on that. And so this is something that they do, right, in response to inflation. They will raise or lower the Fed interest rate, right? So if inflation is really high, they want to raise those interest rates so people can't have access to money as easily, right? They aren't able to buy as much because mortgage rates are high, car loan rates are high, right? Credit card rates are high. So they kind of slow the economy down, slow the inflation down. Versus if they're trying to kind of gas the economy, right? They'll lower interest rates and then there's access to a lot more easy money, right? And people will spend more. And so it kind of boosts the economy again, right? And so we see them kind of caught right now in between those two things, right? And I'll talk about this a little bit more on a future slide, what is happening here. But yeah, we're seeing inflation going up, but also a lot of these other things are happening too, right? Where the economy is slowing down. And so, like I said, we'll talk about that a little bit more. First, I wanted to bring up this Zimbabwe example of hyperinflation. And I think this is pretty interesting. And this has actually happened in a lot of other countries too. This isn't Zimbabwe specific. This story is interesting. But it's also, Germany had hyperinflation between the two world wars. I think Hungary has had the highest hyperinflation of any nation. Greece has had hyperinflation. So it's not actually that unusual for this to happen. But I did bring see if you can see it, my $20 billion, here we go, trying to get my camera to pick it up, Zimbabwe bill from when I was over there. So this happened back in like 2007. And you'll probably hear some parallels to what's happening in the US today when I talk about this. So at the time, they had a pretty corrupt president. It was President Mugabe. And so one of the things he was pushing was an anti-immigrant policy. So he was trying to get rid of immigrants in Zimbabwe, and it's a different continent, different country. So those immigrants were actually mostly white people that he was kicking out. And so that was causing a destabilization of the economy over there because they were losing all these people, right? And we're kind of seeing this here now in the US, right? Also, a lot of immigrants are being sent away. And so another thing was this corrupt administration. He was funneling a lot of money to his cronies, his companies. And we're again seeing some of that now here in the US. And then the third big thing he did was he started a war with the Congo that he needed to fund. And so he started printing a bunch of money to fund this war. And that was really sort of the final straw that caused the massive hyperinflation. Was he was printing all this money, dumping it into the economy, and it was devaluing their currency. So at its peak, the daily inflation rate was going up 98%. So if you got paid $10 in the morning, by that evening, that was only worth $5. So people were just frantically trying to convert their money into other currencies. And so it was causing a huge disaster in the economy. They weren't able to produce enough food. This bill I have up on the screen, the $100 trillion bill, that's the biggest bill they ended up printing. And at the height of their inflation, that would not even buy a bus ticket. So they ended up having to ditch their currency entirely. And they actually run on the US dollar now. So when we were over there, one of the big ways that they get the US dollar, right? Because they don't print the dollar, it's only printed in the US. One of the big ways they get it is actually from tourists. So when we crossed the border into Zimbabwe, we had to pay, it was like $200 a person. It was a pretty significant amount in US dollars to get into their country. And so that is one of the main ways that they are able to get US dollars over there. And there are other countries in the world that have had the same type of issues with their currency collapsing, and they've had to also go on the US dollar. I think Ecuador is also on the US dollar right now. So that was their solution, but they are still really struggling to get their economy going again. So this is definitely something we're going to have to watch out for. It. The US, has, I think, a more stable structure than a lot of these other countries did at the time when hyperinflation took off. But, it's definitely something to keep in mind, right? Keep an eye on it and make sure that, because we do have some things in common with these other countries that this has happened to. So keep it in the back of your mind that it's something to watch out for. So what is happening in the US today with inflation? So the Fed typically is looking to keep inflation around 2%. That's their goal. That allows the economy to still grow, but it's not really impacting people significantly to the point where they can't buy things, right? So what we've seen this year, the annual inflation as of the end of March is up 3.3%. So it is still higher than that 2%. And then, of course, where we're really seeing it right now is in gasoline, right? So since the war started, gas is up over 50%. So that's really where it's hitting people's pocketbooks. And I think we'll see more of that kind of trickle down effect as, these products that are made with petroleum and products that are shipped, obviously, those prices are probably going to get more expensive. And this could last easily another year, unfortunately, those trickle down effects. But if we look over time, so the 5-year US inflation has been about 22.7%, but the 5-year US wage growth has been 21.8%. So it is lagging a little bit, but not that much. And so as long as we see those two numbers pretty close together, the economy stays pretty stable, right? Because people, they're getting paid more and they can pay the higher prices for things. So when it really starts to be a problem is when inflation takes off and that wage growth number does not. And this is when we get to stagflation, which actually happened in the US in the 1970s, really slowed the economy down. So that is when we see inflation, right? So prices are going up and economic growth is going down. The wages are not keeping up with the inflation rates, and we see a lot of unemployment at that point. And that really locks the economy, right? Because there's just really no good solution of what to do at that point. And we're even, I would say, here in Austin, in the real estate market, we've been seeing a lot of stagflation, sort of a micro stagflation market. And I think that's true in quite a few other real estate markets around the country right now. I know with my rentals, I have been having to lower my rental rates significantly, but my costs are still going up, right? So my insurance has more than doubled, and my taxes are going up, and the cost of maintenance and construction materials, all of that's going up, but I am not making any more money. In fact, I'm making less money than I was before. And so that is an example of like a micro stagflation that we're already seeing in some areas of the country. All right. Before I go on into this, does anybody have any questions? Or Caitlin, do you have anything to add?
Well, I would add to, if you go back, I think it was two slides prior to this, just those inflation numbers, I think that they're important because you could see that our goal up here is 2%. And like Susan said, our goal is really just driven, that's it's something that economists have determined, like if we continue to grow at this rate, this is a healthy rate that doesn't, outpace people who are trying to earn money and build wealth, but it ensures that our economy keeps growing. So inflation is good, but too much of it is obviously harmful to most people in our country. And I think that what is so shocking here is if you look at our 5-year US inflation number, this is a cumulative number, right? So this is not our year over year inflation. That would be really bad. But 5 years, if our goal was 2% each year, it should be closer to 10%, right? So we're more than double what we want inflation to be. Um, and I think that I know we're going to talk about this a little bit more, but when so many women that we work with, and not just women, but women and their partners, will express an individual aversion to risk. I'm afraid to put my money in the stock market, or I'm afraid to invest more. And we get that because there's volatility there. And that volatility makes it really uncomfortable when we're watching our net wealth, really fluctuate. It's great when it's going up. It's really concerning when we see it going down. But one thing that I want to highlight here is these inflation rates are exactly why we need to be not just letting so much of our money sit in cash. And that's why we're really often emphasizing, like, have an emergency fund, but don't overfund your emergency fund, because we want to be able to have our money invested. Yes, there's going to be volatility and there's going to be some losses, but year over year, we are mostly going to see higher growth in our investments than we see in inflation. And when we don't have that, if we're not investing our money and it's not growing faster than inflation, that is not just a risk, that is an actual loss. So I always like to highlight that is, yes, investing comes with risk, but not investing comes with even greater risk because we are facing inflation. So if we're not growing our money faster than inflation, then we are losing money. So I always just like to highlight that, just to put our risk in perspective and how risky is investing. Yes, there's volatility, but it's also important to know that when we're not investing, we're actually at risk of losing more money.
Mhm. Yeah, and it's even something important to think about when you invest in things, say real estate, or, I've invested in a lot of real estate syndications that aren't paying out right now. And even though, I mean, I would actually at this point be happy just to get my initial investment back. But, 5 years later, I've actually lost 22.7% of my purchasing power, right? If I just get that same investment back and never got any cash flow from it. So that is something to keep in mind with those investments. Yes, you might not lose anything on the surface, but you could actually be losing that purchasing power. So that is something to consider when you're looking at different investments too, and what makes sense. All right. So how can I protect my portfolio? And like Caitlin was saying, leaving your portfolio in straight cash is usually one of the most dangerous things you can do, even though it seems like on the surface that would be a great safe option, right? Yeah, you've just got the cash sitting there. It's not volatile, but you're actually losing a lot of purchasing power on that cash over the years. So what else could you put those funds in? Well, a good option for some of your portfolio may be inflation indexed securities. And so these are bonds that the government offers that actually have the inflation rate built into them. And so these are Treasury inflation protected securities tips, or I bonds. So the way that these work is they come with a set interest rate. So for instance, I bonds right now, that interest rate is close to 1%. And so that bond will have that 1% set interest rate for however long you hold it. And then you get the inflation rate on top of that, and it changes every 6 months. So right now, the rate just changed on May 1st, the beginning of this month. They're currently paying 4.26%. So right now, the actual interest rate that you're getting on these bonds is not great, but they are inflation protected. And we really saw the impacts of this after the COVID stimulus checks came out, right? Because inflation just shot up because there was all this extra money in the economy. And so these I bonds were paying close to 10% at that time. And like more than 9% of that was inflation, right? The inflation rate on those. So this can be a good place to put money. Unfortunately, I bonds are limited to $10,000 a year. You do have to hold them for at least 1 year. And then if you don't hold them for at least 5 years, you do have to pay a small interest penalty on them, usually 3 months worth of interest. And I do want to point out, these are mainly stabilizers in your portfolio. So these are not growth assets, right? So if you put all of your money in these, you'll stay pretty much even with inflation, but you're not really going to grow your portfolio a lot. So these are a good sort of hedge to have in your portfolio for a certain percentage of your money, just to make sure that something is keeping up with that inflation. All right. Some other inflation resistant assets tend to be things that are real assets, right? So, like real estate, so owning like property, owning like actual things that the price would still continue to go up with inflation. Um, Even stocks, right, can be inflation resistant assets because you're buying a piece of a company, right? So, real estate is good. REITs, which are also a form of real estate, can be good. Commodities, right? Because those are goods. Um, Energy and oil, and also consumer staples. These are good because people have to keep buying these even when inflation goes up, right? So people still need toilet paper and paper towels and food and oil. And so these can be a really good hedge against inflation. And then, like I said, stocks in general actually tend to be a pretty good hedge against inflation because you are owning a piece of a company. And so hopefully, as inflation goes up, they are able to raise their prices and they get more profits, and then the stock price goes up, right? And so these can be a lot more useful than just having your money sitting in, a savings account at the bank or a checking account, to be invested in these real assets.
And I'll add to that, having an indexed portfolio will inherently cover most, if not all, of these sectors. So, one thing that we're not doing is saying like go and just like really lean your portfolio completely into commodities. That's risky, and
Yeah.
it's important to diversify. But these are different sectors that are most likely in your portfolio if you have an indexed portfolio, meaning you have a portfolio with index funds, and those are, you know, reflecting funds that are tracking to certain indexes. And that's why, when if you are just invested in Netflix, your portfolio is most likely lacking in these other sectors here. So it's so important. We've talked about, oh my gosh, diversification is really something that can help us when we do see a lot of volatility in the stock market, when, a lot of the market is really tanking. That's why it's great to have other index funds, that are still doing well, and it's still representing parts of our portfolio that are strong when other parts of it are weak. And then the same thing here, as far as being able to hedge against inflation. I just always like to draw the parallel that, this slide doesn't mean, hey, go just invest in real estate or just go buy a bunch of REITs, but hey, go ahead and look at the index funds that you're already invested in. And there's a very good chance that you're already spread across so many of these sectors.
Yeah, that's a really good point. And even investing in just, a low cost index fund that's tracking the whole market, like VTI or VT, which also adds in the global market, something like that will include a lot of these real assets within it with a lot more diversification. So it won't be as volatile, but you'll still get protection against inflation. And one more thing I wanted to say about real estate is ideally, as inflation goes up, the price of your real estate would go up, and also the price of your rents would go up. And so that's a way that real estate can be a good hedge, and provide the cash flow, that extra cash flow that you would need to make up for the inflation rate. Now, as I mentioned, here in Austin, that's not happening right now, but ideally, in a strong market, we would see that happening. And we've mentioned before, and Caitlin did a really good newsletter on this, the K-shaped economy that we're in right now. And something that we've pointed out is it is to be on the top side of that K right now with the economy. It is people that own real assets, right? It is people that are invested in the stock market. They own pieces of companies. They own their own business. They own real estate. And we're seeing this bigger and bigger divide between the people on the top of the K and then the people on the bottom of the K that are living paycheck to paycheck. The only money they have coming in is generally their wages. They have a lot of debt. And so I think it's going to be more and more important, especially if we do go into this higher inflation environment, to be on the top side of that K by owning these real assets. All right. But if you do want to keep some money in cash, and you should keep some money in cash, right? You should always keep an emergency fund. I actually have a little bit more money in cash than I normally do because the stock market has been a little bit more volatile. I'm not going to pull out my stocks. I've actually seen a lot of people doing this lately in these investing groups I'm in, where they're so concerned about AI that they've pulled out all of their stock investments. And I would not recommend that, because it's something that still is going to ebb and flow. And it is so hard to time getting back in at the right point. You could easily lose all of your money. Um, but I do feel like right now it could be smart because things are a little more volatile, especially if you're living off your portfolio, to have a little bit more cash than usual. But even so, you should probably be keeping 3 to 6 months of expenses in an emergency fund. But preferably don't just keep it in cash under the bed, right? Especially in this inflationary environment. So good places to keep that cash. You want to, like Caitlin said earlier, try to at least match the inflation rate, right? So you're not losing purchasing power. So some of those options would be a high yield savings account. I think mine is paying maybe 3.3% right now. So it's about matching inflation, maybe a little bit lower than inflation, but it's better than just a regular old savings account where you're making like 0.001% on your money. Money markets can be a good place to keep your money, and they tend to pay a little bit more. Short-term bonds, they tend to operate like cash equivalents, like SGov, SGOV is a short-term bond fund, and it tends to operate pretty much like cash. And I want to say it's paying I think it's 3.55% right now. So it's doing a little bit better as far as keeping up with inflation. And then having fixed rate debt, right? So a lot of us who bought real estate during that sort of post-pandemic period have these amazing mortgage rates right now, right? So my house is at 2.5%. Well, that's a great arbitrage for me, right? So I've got that debt, but I can earn, minimum 3.5% on my money, if not more, right? And so if you can get into fixed rate debt at a decent rate, that's a good hedge against inflation because your payment stays the same on that, right? Where what we don't want to see is floating rate debt. And we've seen that happen with a lot of like commercial real estate when they bought in and that height of the market, right? The height of the real estate market, sort of post pandemic. And they had floating rate debt and they, had underwritten these, 3 to 4% interest rates. And then suddenly the interest rates are 10 to 12%. And their whole portfolio just falls apart. They can't cover that extra cost. So having floating rate debt is not great in an inflationary environment. So you definitely want to stick to fixed rate debt. But in a lot of cases, especially with these really low mortgage rates, it doesn't make sense to pay it off, right? Because you got this great arbitrage where you can actually earn more money. It's like free money. So that's definitely another hedge against inflation if you can get a good rate. And Caitlin, do we have questions in the chat? I can't see the chat on the window I'm in.
No questions so far.
Okay.
May brought up a great point, before when we were talking about ways to hedge against inflation as far as being your own money lender. So this is kind of the opposite. Susan, you're talking about fixed rate debt, but actually, if you're lending out money, you could potentially secure a higher rate interest on that money that you've loaned out than what you would get, say, at a bank. So that is, what I would classify as an income stream. It's not necessarily like parking your money in a safe liquid fund. But you're putting your money out to work for you, which is awesome. And I think that's also a great hedge against inflation and being able to apply that to one or more of your income streams is awesome. And it's a really good risk mitigation strategy.
Yeah, I agree for sure. All right. So the final takeaways, number one, avoid cash erosion, right? Don't leave your cash just sitting where it's not making anything or it's making less than inflation. Try to include some of these inflation hedges in your portfolio. Those, inflation protected bonds and these real assets that we talked about. Use fixed rate debt. And then another big one is increase your income. And that was a great point, Caitlin, that you were just bringing up about loaning out money, right? So this is a great time to think about, okay, how can I make my money work for me? How can I make my skills work for me as far as like a side hustle, right? Also, even negotiating raises, right, at work. Can do that if inflation is really taking off, or even changing jobs where you're making a higher salary at a new job. So there are quite a few things you can do to kind of hedge against inflation and keep your portfolio from totally tanking if the inflation rate really takes off.
Yeah, and developing the right tax strategy too is, I know that's something that we talk about a lot, but when we talk about adding side hustles, increasing your income, having the right tax strategy also increases your income, right? It puts more money for you to be taking home, and thinking about how that compounds over time is really eye-opening. And even we don't talk enough, I think, in just in general in the financial world about location of our money too, and making sure that we're putting our money in the right place so that it's getting the optimal tax treatment that it can based on when we expect to use that money, when we're withdrawing, what tax bracket we're going to be when we withdraw that money. So that's also something that I think about too when it comes to hedging against inflation, is just having that much more money that you didn't necessarily blindly pay in taxes when you could have avoided that.
Yeah, I think that's a great point. And I love tax strategies. I could have put in another slide, I
No,
guess, on tax strategies here.
no, I really just said that to get you going.
Yeah. But that's very true, right? I mean, that is another income source. A lot of people don't realize it, but I mean, you can often make more doing good tax strategy than you can at like getting a second job,
Yeah.
right? And so that is another really good way to hedge against inflation for sure.
And one thing that I want to call out too, when we use the word inflation, I mean, I always associate it with our economy in general, but we really do see specific instances of inflation inside of our economy. And, even when we're not necessarily in a time of high inflation, we usually tend to see pretty constant inflation in very specific industries or domains, such as education. Susan mentioned before. I think we all know that like college tuition is off the rails as far as costs go, and those costs have been rising at a much higher rate than the inflation of our economy. So that's also something that is important to keep in mind, is if you are saving for college tuition, you want to make sure that you're getting whatever money you have invested for that college tuition. As long as you have the right timeline for this, you want to make sure that you're getting a return that is hopefully greater than the inflation that you're seeing in college tuition. And other areas where we see industry specific inflation is, Susan mentioned gas before. A lot of times, unfortunately, we see that gas is climbing at a much higher rate than we see other goods climbing. In the same vein, it might also fall. So we tend to see just like a lot of volatility in gas. So lots of inflation and some periods of deflation, but overall a lot of inflation. And then healthcare is another industry where we see a lot of inflation, where no
Yeah.
matter what the inflation of our economy might be doing, we tend to see healthcare costs rising at their own rate. Um, so many of the goods that we see at the grocery store, whether we're going out shopping for school supplies or clothes, so much of that is really tied to the inflation of our overall economy. And then we also tend to see these certain industries that have inflation that you can't necessarily tie to our economy and may or may not be tied to the rising rate of other goods. And healthcare is definitely one of those. And we've talked a lot about healthcare in the past, and there are a lot of reasons why healthcare has its own pattern for rising costs. But I want to clarify that because sometimes you'll see the word inflation not just tied to our economy, and people will talk about inflation as it relates to the rising costs of something. And there are ways I want you to remember that we can mitigate that. We cannot control inflation. And as much as it would be great for us to have the ability to slow inflation down of certain goods or certain industries, we at least have some tools to try and fight against that inflation and try and keep our wealth at least on pace and hopefully ahead of that inflation.
Yeah. And, sometimes we do see the government step in other ways too, other than just, raising and lowering the interest rate. There were, I think, eggs were way up, different food products, go up and down. Sometimes beef will go really high, and the government will actually step in and provide subsidies or some sort of, cost relief to farmers, to bring the prices of those back in line with everything else. So we do see them using a lot of tools too, like Caitlin is saying, just even individually versus controlling the whole economy.
Yeah.
And what you said also made me think maybe I should have put in the slide on how to save on healthcare costs, because we did that presentation a couple months ago too.
Yeah.
And
Yeah,
it's
that I think that was maybe our Wealth Wednesday of November 25, if you're curious about that and if you're feeling the healthcare inflation pinch.
Yeah. So it all kind of ties in together, right? All these financial topics that we're talking about also tie in with inflation and the overall health of the economy and how to protect your own net wealth, right? From being eroded by high costs, by inflation, cash erosion, all these different things, taxes. Um, so fundamentally, that's the goal, right? Is to protect what you've earned. No matter what's going on around you. All right. I do have this slide at the end. You can scan this QR code if you want to talk to us. We love talking to people about their financial strategy. And we always have a lot to say. If you're interested, you can schedule a call with us. And we also have a weekly newsletter that goes out. Of course, we do these Wealth Wednesdays, first Wednesday of every month, to talk about different financial topics. We have a blog on our website. So yeah, we want to be here to help you in any way that we can. And I guess if you guys have any questions, feel free to put them in the chat or come off mute and we will answer them.
Thanks, Susan. Oh, thanks for your question, May. Yes, these webinars are posted on our YouTube channel, which we tend to link to also in our newsletter. Let me get our
Yeah, that's
channel
good.
up
Try to
in the
find the
chat
link.
for you.
Yeah, we should probably include the link to the replays in our newsletter, like on the Wealth Wednesday section. I'm gonna make a note to do that.
Yeah, yeah, we can do that more consistently for sure. Yeah, so you can catch those previous webinars, and we hope to have you keep joining and bring your questions. Feel free to send us questions ahead of time. And if there's a topic that you want us to discuss on one of these Wealth Wednesday calls, we'd love to hear about those. We always are wanting to make sure that we're in touch with what our community wants to know. So don't be shy. You can always reach out to us. We have a contact form on our website, but I'm Caitlin at risingfemwealth.com and Susan is Susan at risingfemwealth.com. You'll be able to get both of us anytime you email hello at risingfemwealth.com too. So don't be shy. Never hesitate to shoot us some questions. And
And I
thank you
think
so much.
next week or next month, we're going to be talking about sort of a mid-year portfolio edit.
Right. Yeah, so I'm excited for that topic. This is a great one if you are just wanting to understand how do I get more comfortable like checking on my portfolio? What should I even be doing? Is that a thing? Do I need to be checking on my portfolio? So this isn't just, hey, this is for someone who's already been in the routine of you're doing constant rebalancing. No, this is for anyone who's curious about how to do maintenance on your assets that you own and how to take a look at them and how to decide what moves you might want to make. So next month, first Wednesday of June is going to be that mid-year portfolio edit topic.
And that's also a great time to check on like your 401k contributions to make sure you're not going to be over for the rest of the year. You can go ahead and sort of plan out that last 6 months of the year to make sure you're hitting the number you want, even IRA contributions, HSA contributions. Start looking at what your income is going to be for taxes, see if there's any tax moves you want to make the second half of the year. So June is really that's a great time to be taking a look at your portfolio and kind of seeing where you are for the year and what you want to accomplish by the end of the year. All right, I don't see any other questions, so I think I think we're done for today. We really appreciate all of you guys coming and participating. It's a lot of fun to be able to do this. So,
Yeah, great to see you all. We'll see you next
all
time.
right. Bye guys.
Bye.